Hello and welcome. I'm Saeed from StoryPlanet.net. Dive right into the essence of the most captivating books without reading them cover to cover. Whether you're on the go, at the gym, or just relaxing at home, we offer you a unique and enriching listening experience. Today, we are exploring the book, The Little Book of Common Sense Investing, a creation by John C. Bogle. The Little Book of Common Sense Investing compares actively managed funds and index funds. It recommends investing in low-cost index funds over high-risk, expensive mutual funds to grow your money more efficiently. Before we delve into these revelations, it's interesting to note that John C. Bogle, the founder and former CEO of Vanguard Mutual Fund Group, an American investment firm, is known for his popular book, Common Sense on Mutual Funds. Copyright AC 2007, John Wiley & Sons. Reproduction without authorized permission is prohibited. With 6 key ideas to unveil, brace yourself for a deep dive into this captivating book. On StoryPlanet.net. To start, discover the benefits of index funds and why they are considered a superior investment option. The text discusses the overwhelming variety of mutual funds available and suggests that investing in low-risk, diversified funds can be a secure option. It highlights the benefits of index funds, emphasizing their cost-effectiveness and why they can be a better choice than other types of mutual funds. Key points include differences between passive and actively managed funds, the importance of low fees, and strategies to avoid market bubbles. Key idea number 1. Actively managed funds are costly and often fail to beat the market. Investing directly in stocks can be complex, leading many to opt for actively managed funds. These funds are pooled investments managed by experts who adjust the portfolio regularly. Yet, such investments carry high costs that can eat into profits. Actively managed funds are often outperformed in the long run by passive index funds due to excessive fees and the difficulty in consistently beating the market through stock speculation. Over time, the fees can significantly reduce overall gains, making passive index funds a more profitable option for many investors. Key idea number 2. Many funds do not perform well, and even among the few that do, there is no guarantee they will continue to perform well in the future. Actively managed funds often underperform the overall market, with only a small percentage consistently outperforming. Paying high fees for financial experts to manage funds may not be worth it, as past performance does not guarantee future success. The success of a fund can be attributed to specific market conditions and individual fund managers, which may not be sustainable in the long run. Future investment opportunities and fund managers may vary, making it risky to rely solely on past performance for investment decisions. Key idea number 3. People commonly invest in actively managed funds without full understanding of the consequences. Investors underestimate the true cost of actively managed funds due to undisclosed expenses, leading to lower actual returns. Emotions and market trends often influence investment decisions, pushing people to follow popular opinions, even when it may not be sound. This behavior was evident in the late 1990s with high-risk investments. As an alternative to actively managed funds, there are more sensible investment options to explore. Key idea number 4. Invest most of your assets in safe, low-cost index funds for long-term growth and stability. Index funds are more cost-efficient than actively managed funds, as they hold a diversified portfolio reflecting the financial market without making short-term bets. They track market performance and are considered passive funds, eliminating the need for individual stock betting and minimizing operating costs. Index funds tend to outperform actively managed funds in the long term by offering returns at the real value of stocks and reducing active management costs. Key idea number 5. Select the most affordable index fund. Index funds have expense ratios that represent management fees and operating expenses, typically less than 1%. Even small differences in expense ratios can impact long-term investments. Choose an index fund with the lowest cost structure as expenses accumulate over time. emphasizing that performance is not tied to a company's expense ratio. Key idea number 6, caution advised regarding new investing trends. When considering investing, be cautious of new trends in index funds. There is fierce competition with 578 index funds in the market, each trying to attract investors by offering lower costs or new stock-picking methods. Stick to funds with normal portfolios, as it's hard to gauge stock values accurately. Prioritize low costs over new trends due to uncertainty in their success. In conclusion, actively managed funds are seen as a poor investment choice compared to index funds. The book recommends investing the majority of assets in index funds for better returns. It advises limiting investments in actively managed funds to a small percentage, with the majority in safe, long-term investments. Further reading is suggested in The Intelligent Investor by Benjamin Graham. The book provides advice on successful investing from Graham's experiences post the 1929 financial crash. Feedback on the content can be provided via email for discussion. Thank you for listening to this summary. If you enjoyed this exploration, we invite you to discover other fascinating books on storyplanet.net. Don't wait any longer. A multitude of books, stories, and knowledge await you there. See you soon on storyplanet.net.